Money melting, understanding inflation. Inflation is a term that often gets thrown around in economic discussions, but what does it really mean? Simply put, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently the purchasing power of currency is falling. Inflation. It's a big word that means your money buys less over time. When inflation occurs, each unit of currency buys fewer goods and services. This erosion of purchasing power impacts everyone, from individuals to businesses and even governments. Imagine a candy bar you loved. Last year it cost $1. This year it's $1.50. This increase in price is a simple example of inflation at work. Over time, the cost of living increases and the value of money decreases. That's inflation. What causes this? Too much money chasing too few goods. When demand for products and services exceeds supply, prices go up. This can happen for various reasons, such as increased consumer spending, government policies, or supply chain disruptions. Think about a popular toy with limited supply. Everyone wants it, so the price goes up. This is a classic example of demand-pull inflation, where the demand for goods and services outpaces their supply, leading to higher prices. Inflation hurts everyone, but especially those on fixed incomes. For retirees and others who rely on a fixed income, rising prices can be particularly challenging. Their income doesn't increase to keep pace with inflation, making it harder to afford basic necessities. Your salary might stay the same, but your money buys less at the grocery store. This is known as the cost push effect, where the rising costs of production lead to higher prices for consumers. Everyday items become more expensive, stretching household budgets thin. It's like a hidden tax, slowly eating away at your savings and purchasing power. Inflation reduces the real value of money over time, meaning that the same amount of money will buy fewer goods and services in the future. This can erode savings and make it harder to plan for the future. Don't let inflation win. Learn how to protect your wealth. There are strategies to mitigate the impact of inflation, such as investing in assets that typically appreciate over time, like real estate or stocks. Staying informed and proactive can help you safeguard your financial future. Disappearing savings when money stops working. When inflation soars, your local currency loses value rapidly. This is called currency devaluation. Imagine your savings are in a currency that's losing value every day. That's what happens during high inflation. Your hard-earned money can't buy as much as it used to. It's a scary situation, but there are ways to protect yourself. By diversifying your savings and investments, you can safeguard your wealth from the erosive effects of inflation. Escape the currency crisis, foreign currency and stablecoins. In times of economic uncertainty, people often look for ways to safeguard their wealth. One effective strategy is to diversify their holdings into foreign currencies and stablecoins. One way to fight inflation is with foreign currency. By holding foreign currencies, you can mitigate the risk of your local currency losing value. This is especially important in countries experiencing high inflation rates. This means holding money like US dollars or euros. These currencies are considered strong and stable, making them a reliable option for preserving your wealth. These currencies are often more stable than those in high inflation countries. For instance, the US dollar and the euro have historically shown resilience against economic downturns, providing a safer haven for your money. Think of it as having a lifeboat in a storm. Just as a lifeboat can save you from a sinking ship, holding foreign currencies can protect you from the financial turmoil in your home country. When your local currency sinks, you have a backup. Another option is stablecoins. These digital assets are designed to maintain a stable value by being pegged to a reserve asset like the US dollar. These are digital currencies often pegged to the US dollar, offering similar stability. Stablecoins combine the benefits of digital currencies with the stability of traditional fiat currencies, making them an attractive option for those looking to protect their wealth. By holding some savings in foreign currency or stablecoins, you can protect your purchasing power from local currency devaluation. This strategy not only helps in preserving your wealth, but also provides peace of mind, knowing that your money is secure regardless of the economic conditions in your home country. Diversifying your holdings into foreign currencies and stablecoins is a prudent approach to financial security in an unpredictable world. Owning your future. Investing in real estate. Real estate is a tangible asset that tends to hold its value during inflation. Land and buildings are in limited supply and demand often rises during uncertain times. As your local currency weakens, the value of your property measured in that currency can increase. Rental income can also provide a hedge against inflation, as rents tend to rise along with prices. Investing in real estate can offer stability and potential appreciation, protecting your wealth from inflation's erosion. Section 5. Looking beyond borders, international stocks for growth. In today's interconnected world, the opportunities for growth are not confined to your home country. By looking beyond borders, you can tap into the dynamic potential of international markets. International stocks represent ownership in companies based in other countries. These companies operate in various economic environments, offering unique growth prospects that might not be available domestically. By investing in international stocks, you gain exposure to different industries and markets, which can be particularly beneficial if your home market is underperforming. Investing globally can help you benefit from growth in stronger economies. For instance, emerging markets often experience rapid economic expansion, providing substantial returns for investors. Additionally, developed markets like Europe and Asia have established industries that continue to innovate and grow. By diversifying your investments across these regions, you can capture the growth potential of multiple economies. When your local currency is weak, earnings from international companies can translate into larger gains when converted back. This currency diversification can act as a buffer against local currency depreciation, enhancing your overall returns. Understanding the impact of currency exchange rates is crucial, as it can significantly influence the performance of your international investments. Diversifying your portfolio with international stocks can provide growth potential and a hedge against local economic challenges. By spreading your investments across different countries and regions, you reduce the risk associated with any single market. This strategy not only enhances your growth prospects, but also adds a layer of protection against economic downturns in your home country. Remember, investing in stocks involves risk, but it can be a powerful tool to outpace inflation over the long term. While international stocks offer exciting opportunities, they also come with their own set of risks, such as political instability and regulatory changes. It's essential to conduct thorough research and consider working with a financial advisor to navigate these complexities. By carefully selecting a diversified portfolio of international stocks, you can harness global growth while managing potential risks effectively. Section 6. Finding your path. Choosing the right investment strategy. The best way to invest during high inflation depends on your situation. For short-term goals, foreign currency or stablecoins might be suitable for preserving capital. For long-term growth, real estate and international stocks offer potential for appreciation. Consider your risk tolerance, investment horizon, and financial goals before making any decisions. It's crucial to consult with a financial advisor to develop a personalized plan that aligns with your circumstances. Section 7. Zimbabwe and Argentina cautionary tales of hyperinflation. Zimbabwe and Argentina stand as stark reminders of inflation's devastating effects. These nations experienced hyperinflation, where prices spiraled out of control. In such extreme cases, even basic necessities become unaffordable, leading to economic turmoil and social unrest. These cautionary tales highlight the importance of taking proactive steps to protect your wealth from inflation's grip. By understanding the risks and taking appropriate measures, you can safeguard your financial well-being. Section 8. Timing is everything, recognizing investment opportunities. Knowing when to invest is as crucial as knowing where to invest. During high inflation, opportunities often arise in unexpected places. Pay attention to undervalued assets or businesses with strong fundamentals that are temporarily affected by market sentiment. However, it's essential to conduct thorough research, seek expert advice, and avoid emotional investment decisions. Timing the market perfectly is impossible, but recognizing potential opportunities can significantly enhance your returns. Section 9. Protecting your wealth, taking control of your financial future. Inflation is a challenge, but it doesn't have to control your financial destiny. By understanding the risks and exploring investment options, you can protect and even grow your wealth. Remember to diversify your portfolio, consider foreign currency or stablecoins, explore real estate and look for opportunities in international stocks. Take control of your financial future and navigate the complexities of inflation with knowledge and confidence.